Right. Hey, good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office, October 2024 First Friday meeting. Today's presentation is titled The Elephant in the Room. Today, we are going to discuss several risks everyone is aware of, yet no strategist or portfolio manager or analyst is actually prepared for. These are well-known risks staring us right in the face. Yet because they have not happened during our lifetimes, very few have prepared their investment portfolios for the possibility that they will happen. We will meet these unfriendly elephants and discuss intelligent investments, which can both protect us if these really scary events take place, yet deliver a reasonable return if we are fortunate enough to avoid meeting these elephants face to face. Today, our prepared comments will be recorded, as other families who are unable to attend have asked us for the recording. Our comments today will be approximately 20 minutes long, leaving us plenty of time to take questions from participants. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the React or Reactions icon at the bottom of the screen. I wanted to remind you that we really do enjoy your questions, and we will do our best to get to them at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Matt Daly and Stephen Abernathy, who will provide today's commentary.
Welcome. I'm Stephen Abernathy, and this is the October 2024 First Friday meeting for the Abernathy Group family office members. This is our 23rd monthly meeting. Wow, can't believe time has gone this quickly. All of the meeting recordings are available on our YouTube channel and on our website. If you have any interest in going back and seeing the topics that we discussed and how right or mostly how wrong we were. And by the way, for those of you who haven't been to our website lately, please consider stopping by just for a minute. It's a new website, and there's a wealth of information on how to continue your journey of becoming a more intelligent and more insightful investor, along with some estate planning ideas each of you should be sort of contemplating or discussing with us, as is likely the future, depending upon which administration becomes residents in Washington next year. It's probably going to allow the citizens of the U.S. to pass along less to our beneficiaries when we pass away. And for many who are dedicated to taking full advantage of our tax system, to be taxed on this hard-earned money that we've saved will be a bitter pill to swallow if we are unable to pass it along to our state to those that we choose. Also, just as a new topic, we recently started a new company focused on reducing the costs of offering employees a corporate 401k plan. While our goal is to make sure that the employees get the educational information needed to make intelligent decisions about their retirement plan investments. So the new website that you'll have access to, if you have an interest, describes several methods or strategies to reduce your overall retirement plan costs while improving your 401k plan for all of your employees. So with that just quick update, let me turn this meeting over to Matt Daly so he can ensure that we cover the several, what I would say is incredibly important topics our members have asked us to discuss with you today. Matt?
Okay, thank you, Stephen. Today we're going to do our best to discuss several uncomfortable topics. However, like many important activities which involve difficult decisions, discussing uncomfortable topics are often the difference between success and failure. Most on this call have worked for decades and achieved a certain level of success in life, which allows them to take care of their families in a manner that they become comfortable with. One of our family office members once commented, "I have worked hard, taken calculated risks, and by the grace of God have benefited enough for my family to live comfortably. I just want to make sure that I don't have to go back and make it all again." I don't know how many of you feel this way, yet if you do, this webinar is definitely for you. Intelligent investing always starts with risk analysis. The reason is because if you lose the assets you are investing, you lose the ability to invest. It's really a first principle concept. It's a very simple and easy to understand concept, yet the vast number of investors we have spoken with over time do not focus on risk avoidance first. And we understand this. Risk is often a negatively focused topic. And few of us want to spend the bulk of our lives dealing with negative topics. Discussing and determining how not to lose money is not a very motivational topic nor exciting. After all, it's much more fun to spend our time on how our investments will deliver profits and how smart we are going to look and feel when this set of circumstances becomes reality and our investment doubles in value. While it is certainly true that the future we envision may well come true, and we hope and plan to do well, there are many other outcomes which could become the future, and because most of us are not adept at calculating the future's probabilities, it is intelligent to spend time on the other side of the outcome spectrum as well. I'm referring to the outcome we categorize as risks. Howard Marks once made the statement when discussing the topic of risk. He said, "You can't predict, you can prepare." He was referring to the fact that there are many more risks which could occur than the risk that actually occurs. And because you can't know which risk you will confront, you must prepare for them all. Or at least you should be aware of them and have a plan in place for each, just in case. This brings us to today's topic. We're going to discuss the big risks which are right in front of us. These risks are so large, I think they're worthy of the elephant moniker. And we are going to do our best to discuss whether the financial markets are pricing in these risks, and if not, why not? So first, we'll briefly discuss inflation and the challenges inflation confronts our society with. The capital markets believe inflation is firmly under control, and we're going to find out if this is a realistic expectation. Next, we will discuss the many outcomes surrounding our presidential election next month. Is there a risk that the outcome will take place without acrimony? Or is there a real risk that there will be some level of conflagration, which could lead to an uncomfortable change in command of the most important country on earth? Of course, we hope and pray this does not happen, yet if it does, what should we expect? Next, we will spend a very short time on our deficit spending. I know we've talked about this in several of the last meetings, and we know it's out of control. We know it's unsustainable. However, what are the alternatives available to us? And lastly, in our estimation, the most serious risk and the risk that is being least priced into the market is the risk of regional hot conflict escalating into a global war, which will instantly increase the risk of a nuclear possibility. And finally, we will do our best to discuss the options available to the US Federal Reserve as the parent or adult in the room in charge of mopping up each of our country's missteps. With that said, let me turn it back to Stephen Abernathy to answer our first topic of the day. Stephen, one of our most active families in our family office asked us the following question, and I'm paraphrasing a little bit here. There are so many events which could create negative outcome to throw us into a dreaded recession. Which is the most likely, and what could our government do to avoid that? Stephen?
Yes. So, Matt, thanks for giving us that. That was really complete, and thanks for giving us a such a background for today's topics. So clearly, there are a number of risks we must be aware of And the challenge is to simultaneously be aware of these risks. And I want to be the first to say this is standard. We're not trying to be like the press and sensationalize anything. There are always risks, and there are always activities we don't believe are risky, yet which turn out to be risky. The housing crisis in 2007 to 2010 is literally a prime example of this statement. And don't forget, from 2004 through 2007, this thing was brewing, and everybody was literally coining money and buying 2 or 3 or 4 houses. Not many investors believed that investing in the U.S. housing market could threaten the global financial system. After all, the question I heard so often coming back to me every time I kind of pushed back on this was, and it's kind of drove me crazy. Isn't investing in a house a guaranteed investment? Houses don't go down in value. In the last 60 years, there's never been a year in which housing has decreased in value. How can you lose? Of course, this was an unintelligent assumption to make. And yes, it was taken to such extreme that it truly almost brought down the global financial system. I remember being in a meeting with Hank Paulson, and just seeing that he was shaken. I mean, literally shaken during that meeting. I mean, his voice was quivering, and he was a big guy. My point is, what was the operational variable which created the downfall? And this is the kind of thing that I want to talk about today. These are just unsuspected variables. First, the cornerstone of almost all mistakes is speculation. When it means, speculation means that investors are buying things for a price that makes no sense. Speculation is a prime villain in almost every serious collapse. And there are lots of speculative activities taking place today in the capital markets. Second, there was leverage. We've discussed leverage at almost every one of our meetings over the course of the last 20 months plus. Leverage, like speculation, is almost always the root of destruction. And as we've said many times, leverage makes good investments or good events great and bad events disastrous. When leverage is at play, everyone on this call should be doubly cautious. And the third variable that led to the last unsuspecting problem that we've had was the U.S. administration convinced everyone that they should own a home or 2 homes or 3 homes. And with this came a level of dishonesty at the lending level, which caused over 400 banks, 465, I think was the right number, to declare bankruptcy. I mean, you're talking about a massive fraud, and just and very few people saw it coming. It's the truth. The reason for this quick history discussion is that most of you are and most of you are well aware of this. It's that private credit is starting to look a lot like the housing bubble in 2006 and 2007. We hope that private credit isn't a similar outcome, or that it avoids a similar outcome. Yet it's one that we're watching closely, and it's not on the agenda today. But if any of you have any questions about the sort of the how would I say, the infrastructure of private credit, please do take a minute and give us a call. Let me stop there just for a second. Let's go on, and then I'll get back to Matt in just a second. So Matt, to answer your question directly, the risks which are most important are the risks we hear about every day. Inflation, it's a silent thief, and we don't believe it's going quietly into the night, as the markets are currently pricing in. We showed a slide several times over the course of the last several webinars that show that the average reduction in inflation, once inflation crosses the 8% level, takes somewhere between 9 and 16 years. That is not priced into today's current market. We believe that today's current market believes inflation is solidly under control, and it looks to be. It's just not what history tells us. We do believe that inflation in the 2 to 3% level will stay with us for an uncomfortably long time. However, it's unlikely to be a risk that those participating on this call should fear first and foremost. So it's a risk. It's going to affect the lower income section of our country disproportionately, but it's not the kind of risk that is a life-threatening risk to anybody on this call. So I would finish this up with saying, yes, inflation is an economic structure to be avoided, as it's literally a silent tax on all consumers, and we're all consumers. However, there's a good side to inflation for those who are in debt. And I would reference for most of you know that we are hyper aware of our country's debt. Inflation allows borrowers to repay their borrowings with depreciated money. So the point is that each year's inflation decreases the amount borrowed by approximately the same amount of inflation. So to some extent, the U.S. Federal Reserve has an incentive to maintain inflation or to allow inflation to exist at levels which slowly eat away our incredible levels of debt. We do expect the Fed to continue to lower rates and be less in tune with the cries for making inflation go down to the 2% level. Let me stop there just for a second and check in with Matt. Matt, does that sort of discuss or kind of explain our inflation challenge? I think you're on mute.
Sorry. Yes, it does. I think that's a good way to cover it, and I think we can move on to the next topic.
Okay, gotcha. Okay, election results. Another topic that is unlikely to become a game changer. It's the presidential election. And yes, there's a probability of about 25% chance, which is not immaterial in any way, shape, or form, that one side or the other will do everything to challenge the other side if the election is close. If the election is not close, I think we're on to the next thing. And yes, you will see the talking heads and the press. They're going to try to do whatever they can to get their money's worth with coverage of one side or the other, creating traffic jams or destroying property if the election is close, as it seems to be. While we hope and pray this doesn't happen, this type of outrageous behavior and potential property destruction, it's not going to change the way we live. I have trouble believing that this is the type of risk that we should be terribly worried about. Mind you, I'm not advocating this, risk. I'm not saying that this is going to happen or condoning it. I'm just saying our country will likely get over it, yet most likely with some bumps and bruises along the way. So our expectation, if this occurs, it will affect the capital markets for a day or a week, yet will probably not have a lasting effect outside of the international damage it will do when other countries around the world see the United States acting very much like a third world country. Matt, any more comments? I know you studied this a lot. Topics?
Yes, no, I think that's right. And I like what you highlighted there at the end, which image wise, we've already damaged our image quite a bit on the international stage. And that is probably the biggest risk going into the election is if what you're talking about does occur, uh, we further cement ourselves as being dysfunctional and starting to look like a third world country. And it will be viewed, I think, internationally as symbolic of our decline, which, puts us in a different position. And that's more of a long-term thing, but nonetheless, it is not good.
Not, I agree. Okay, let's try to move on. When it comes to the next risk, we are not elevating our seismometer, or we are elevating it to an earthquake level. And I think the analogy probably doesn't stop at that point. The level of damage our national debt could create is so large as to be almost unthinkable. It's the kind of risk that could literally change the way we in the United States live. And we separate these risks into kind of two segments. One is a risk that we don't want but we'll get over, and one is a risk that we don't want and we almost might not be able to get over. And this is the kind of risk that could literally change the way we live in the United States. Also, it's eerily similar to the earthquake analogy in that it's absolutely unpredictable. It's truly the living and breathing elephant in the room. We can't tell you when the world is going to get fed up with our debt levels. We've got other countries like Japan that are exceeding our debt levels, and the world is okay with it somehow. We have administrations, Republican and Democrat, both seemingly uncaring as to the amount of deficit spending they put on the books. I mean, overtly going into the year saying we're gonna outspend our revenues by 1.5 to 2 trillion per year. These things are they're almost fictional. Anyway, it's truly, as I said earlier, a living and breathing elephant in the room. It's a risk, and few intelligent investors are allocating for that risk. The reason is that I think the reason is that it's so well known and it's been creeping up on us for so many years, the last 10 or 15 years at record pace. It's almost like our Social Security problem, or our Medicare problem. Yet because there have been no consequences so far, most investors think there will be no consequences. Or they may think that when the US debt crisis starts to unfold, they'll know what to do and they'll have plenty of time to do it. We don't share that stance and urge everyone to have this conversation with the advisor to their family. The next risk is in the same category, and it's so large, it really worries us. It's sitting right in front of us, and I can't believe that almost everyone I speak with, and I mean at the institutional level and at the very sophisticated level, outside of our family office, I don't think I've talked to a single portfolio manager that has an allocation for this risk to become a reality. Matt, do you have anything sort of to say on the national debt line before we move on to the hot wars?
No, I think that's pretty well understood. We spent some time on it, but obviously it's a big problem. But I think, it's well covered, and I'm very concerned about the conflict piece. So I think we can move on to that.
Okay. So, war. Most of us agree it's a predictable event. It's an unpredictable event at best. And we probably all agree that hot wars are much different than cold wars. While both are incredibly negative, hot wars today are similar to our debt crisis. And let me explain that just for a second. So a hot war today, with the amount of nuclear capacity available to most of the countries labeled as superpowers, is scary. It's the same amount, it's the same or similar risk with debt. When you start getting debt in the 30 to 40 to 50 trillion dollar range, it's an event that is almost unfathomable. So these wars that are taking place, these hot wars, they are the definition of a life-threatening event because of the nuclear threat. And I know it's the type of risk that could change everything, and we all know that. And it could change the way we live, it could change our society, and it could literally change the existence or the geography of the earth itself. So this really is the type of risk that is often too uncomfortable to think about and plan for. Although many of us did this in the 1960s. I don't know whether most of you remember this, and some of you might be a little bit too young to remember it, but there were lots of homes that built bunkers in their backyards. So while not much attention is given to a Cold War today, I want to bring up a conversation that Matt and I had earlier this week, that with the technology today, a Cold War could be almost as unsettling. The likelihood of cyber attacks on our US grid, it's a frightening event to consider. I mean, think about this. Well, at least if you live in a large city, it's a frightening event to think about. For anyone living in a city dependent upon electricity for water, for food, for transportation, if a successful cyber attack on our grid took place, how long do you think it would take before LA or New York City became a lawless madhouse? That's for those of you who don't already think New York is a lawless madhouse, which it might be. So the question is, for those, considering how many days it would take of no water and no food or transportation before the city erupted in a lawless bank of humanity, it's almost unthinkable. So the bottom line is, I think that we're one of the only firms which has allocated some level of Cold War and some level of hot war allocations in our energy and in our commodity ownership. So if you'd like to discuss this matter or any of the risks we've discussed here on this, please feel free to give us a call. These topics are incredibly personal, and it just depends on your level of discomfort. Matt, I know that we've talked about this probably to the point that we're exhausted with it, and we're afraid. We're not trying to overbear it, but I think you and I both agree that we want to make sure that everybody listening on the call does embrace the fact that it's a real risk. You have some comments, I think.
Yeah, so I just want to highlight some of the potential risks, and I don't want to create the illusion or make the proclamation that any of this is imminent. But first, I want to talk about some of the risks associated with the hot conflicts that we have, and then I'll get to the cold stuff, because I think there's some stuff that lots of people are not thinking about there. It's different Cold War than 40 years ago. First of all, I know Taiwan and China, I think that is banked. If it's going to happen, I think it's late 2025 or 2026. I think probably 2026. I think that's the intelligence assessment. So that takes a little bit of a backseat. Then you have obviously Ukraine and Russia. That I think has probably been priced in a little bit just because it's been ongoing for a while. And, telltale sign is just the lack of media attention. And I think people have just gotten used to it. The nuclear option's been thrown on the table by Russia, either alluded to or directly. I don't think that that's going to happen. Again, it's a possibility, but if you're trying to buy your neighbor's house, it probably wouldn't be a good tactic to dump toxic chemicals on their property to get them off of it. So I don't think Russia wants to take Ukraine or a portion of their territory. I don't think they would nuke it. Not to mention the global response that would fall on them after that. I think the Middle East situation is a little bit different because it's so ideologically driven and there's so deep hatred there. I don't think it's out of question. Of course, no one thinks that Iran has the capability to do that right now, although they're getting very close if they haven't gotten there already. That is definitely a scary thought. Although also there's what we really should focus on, I think, in the near term is the Israeli response to, what happens after the ICBM launch the other day. The three options that I've been hearing on the table are: one, to take out the nuclear facilities; two, to take out the oil facilities; and three, to take out the supreme leadership. Number one, to take out their nuclear facilities, that's just going to obviously escalate. I don't know exactly what happens next, other than probably a full-out war, which is obviously not good. I think taking out the oil facilities is the most immediate, the easiest to directly see what happens next. Again, it's probably all-out war, but Iran is 4% of the global oil market. Obviously, that would spike prices. Oil, I think all of us know this, but oil tends to, if a pressure brings energy prices lower, it tends to tick down slowly. But if any kind of risk pops up or supply chain, a change in supply like this would be, energy shoots up really fast. It goes down slowly, but it goes up really fast. And that obviously is an input into everything we make, everything we do, everything, in our personal lives and business and everything. It just it'll
Great point.
shoot inflation up. It'll just create our cost of living much higher, and slow the global economy. And 90%, Iran has an island off of it where they process 90% of their oil. So in theory, it's not that difficult for Israel to cripple their entire market. And that, that could happen within days, honestly. So that is a very real risk. The last factor, the last option that's on the table there is to take out the supreme leadership. In theory, that's cutting off the head of the snake and would change Iran's course, but it would also ignite all of their proxy groups across the Middle East and Africa. And, who knows, wherever else they are in the world. And that will just, create little fires everywhere that could, ultimately turn big. So there's a lot of risk factors there. Again, and then those are all the hot conflicts, I'd say, that are at front of mind that present global market risks. Going into the cold aspect, I think when we think about that, a lot of us probably go to critical infrastructure, with the cyber attacks on our energy grid. That stuff, we do have pretty good defenses on that. I'm not saying it can't happen, but we tend to think about big things that would cripple, massive infrastructure. But there's a lot of stuff, a lot of smaller infrastructure things, a lot of, corporate possibilities, smaller cyber attacks, smaller infrastructure attacks. If we remember, I think it was 2013, Iran successfully hacked into a dam in Rye, New York, which is one of the wealthiest towns in the country. And they would have been able to destroy the town if it just happened to be offline for routine maintenance. But they could do that on a large scale and have multiple small infrastructure attacks that would create chaos, would cost billions of dollars of damage or trillions potentially. So that is another possibility. And that's something we haven't really seen on any sort of scale before. You know, like I said, a different type of Cold War now that's available, especially with AI. But their capabilities to hack and to attack infrastructure and cybersecurity issues is pretty robust, honestly. And if you add in, you know, if they are able to pull in any other allies or China, Russia, they're incredibly good at that stuff. Uh, and they could attack companies, they could attack, you know, municipalities, states, anything, and you know, nothing is really off the table there. So that I think that is one of the biggest risks that is probably not getting any discussion.
Matt, your analogy to the Cold War we had most, I guess, largely the last one with Russia, comparing that to today, you're right. There's no comparison from then to now because of the technological, you know, the changes that have taken place. And while I know that we didn't mention the banking system, if somebody could figure out how to hack into the banking system and move a bunch of money from point A to point B, not necessarily even stealing it, just moving it from one, I mean, that could cripple the world economy. You know, anyway, the
Right.
Cold War portion of this doesn't get any press at all. And Matt, I just wanted to thank you for bringing it up and sort of pointing it out to us.
Yeah, if I could point out one other thing there is
Yeah,
Cold War past, you know, everybody thinks obviously of US and Russia, you know, for 50 years. That was a just a level threats going back and forth between major superpowers. This is different. And it has the ability, from what I just outlined, to create essentially a hot conflict amongst the population of the target. So these infrastructure attacks, corporate attacks, anything like that, you know, if, like you
that's
just
a
said
good,
with New York City, how long does it take before people start killing each other over water and food if you take all those things away?
that's a good point.
If you attack the infrastructure, we go to war with ourselves. Because when resources are scarce, people are going to fight for them.
Yeah, you know, this is a rabbit hole I would like to avoid going down. It is it is really scary, and I'm hoping that everybody's thinking through these kinds of things. Um, anyway, let's try to stop there just for a second. Marissa, do we have any questions that have come in from the attendees?
Yes, we do have a question. What will the US Federal Reserve do if A, we enter a recession, or B, if we get pulled into any of the wars brewing abroad?
Gotcha. Well, we just talked a little bit about the um, if these risks actually become a reality and how. But you're right. We didn't talk about how the Federal Reserve would respond. I think that most of you on the call know my stance on this. Uh, it is my belief, my strong belief, and it's and that of some other Fed watchers. Um, we believe the U.S. Federal Reserve will do whatever it takes to avoid a recession. The reason for that is if you move into a recession, you're going to have less revenue from taxes. If you have less revenue from taxes, it increases your deficit. We're moving into 2025 with a planned deficit of somewhere between $1.5 and $2 trillion, regardless of who gets elected, Democrat or Republican. They're both, it's ridiculous. Further, once we get into a recession, that causes deflation. I don't think that the Federal Reserve really understands how to deal with a depression other than with throwing more money into the economy. The problem is when you throw money into an economy that has no return to the entity throwing it in, you're just burning money. And at some point, the second and third order effect of all of this, you have to kind of think it through. The globe or the world or the people who are, or the entities who are buying our debt, well, at some point they'll just say enough. I'm not interested in your debt. Or we might be interested in your debt at 9 or 10% interest payments, which will flatten our country, which will challenge our global hegemony. So the US Federal Reserve knows that if we enter a recession, our deficit spending is going to increase and our income coming from taxes will decrease. To put a number on that, history tells us that it will decrease our revenues by somewhere between 4 to 9% in a typical recession. A really bad recession, it could be much worse. This, as I've said before, just a modest recession would increase our deficit by another 1 to 2 trillion. So it's my firm belief that the US Federal Reserve will try its best to ensure we don't enter a recession. And it will do whatever it takes to keep our job market up and running and to make sure that the job market or the job losses don't impact our US economy negatively. Let me stop there and find out, Matt, anything else, anything to add on to that?
No, I think you covered it well. Just one tiny thing is the piece about the conflict. If the U.S. Federal Reserve will have to unleash more spending if we do get pulled into any sort of high conflict, just because our military readiness is not necessarily at where it should be, and regardless, any kind of hot conflict increases defense spending quite a bit, and that just pumps more money into the economy and prints more money as well.
Thanks, Matt. Marissa, anything else since then?
No, nothing else since then.
Okay, let me take a moment and thank everyone for stopping in today. And if there are follow-on comments or questions, please feel free to no harm, no foul. Call us, have a conversation with us. These are serious risks that we're facing. Some are not life-threatening, some are, and we want to make sure that everybody's comfortable with the way they're allocated. We'll see you next month on the first Friday in November. Bye now.